There's two things there. I think the earnings across the board, as you mentioned, are fairly strong at this point. I don't think it'll be any different in healthcare. As a matter of fact, what we've seen so far in healthcare is most earnings have been fairly substantial. But healthcare is really under pressure right now around political sentiment. And as you've seen, there's been a lot of talk from Bernie Sanders specifically about Medicare for All. And Medicare for All has been putting pressure on the overall space. And actually, we believe, if you look through the space at the HMO stocks specifically, we believe there's a lot of value there at this moment. As a good example, both United and Anthem reported last week. They both grew earnings more than 20%. Yet their stocks are down significantly, with PEs now at 11 times for Anthem, 14 times for United, so significant discounts to the market. We think most of the political overhang, or at least the worst rhetoric, is behind us. And so we think from this point forward, if we can focus on more around the fundamentals, there's significant upside for those names.
And technology has once again been a leader, I think up about 26% for the year when you're looking at the sector as a whole. We've got Alphabet on deck. You talked about some government regulation worries in the healthcare space, but we have to talk about that as well when you look at the tech sector. Is there any risk that what we've seen so far with the tech growth could be curbed in any way, or is that something we need to put on the back burner as we just look at this growth continuing to move forward?
I think in general, the market environment for technology names is very positive, especially with rates now coming down again. That tends to favor growth names. And we'll see how the earnings look, but I would anticipate the earnings growth are pretty good. I mean, those are very strong, healthy companies. You can't ignore regulation in technology or in healthcare because that's sort of the 800-pound gorilla in the room, and it can make a big difference. And so it appears that regulation is starting to turn its head in the technology sector, and that could have long-term implications, just like it did in healthcare, as you mentioned, so far this year. We believe over time fundamentals win out, but regulation is a concern.
And speaking of fundamentals, gosh, it wasn't that long ago when we were all worried about the next recession coming around the corner. But really, a lot of the economic data points have been quite strong. No earnings recession in sight that we've seen, at least so far. So if you're looking at your broader portfolio, risk on, risk off, what's your broader outlook for the market as we keep clipping these new highs sort of day after day? Even if it's a slow melt up, it's happening, right?
Yeah, and there's no doubt. We think that will continue on a moderate basis, but defensive looks expensive to us at this point if you're going to kind of segment the market that way. And so, therefore, more cyclical names look more attractive to us, whether that's consumer discretionary or financials or industrials, energy. Those are the areas that we're focused on right now and finding good value. It's hard to find value, as you mentioned, as the market's up a lot in some of the areas that's either more defensive or more growth-oriented, like the tech sector.